Welcome to the deep dive. We're here to sift through all that information coming at you, cut through the noise, and really bring you the vital insights you need to stay properly informed. This past week, wow, it's been a whirlwind, hasn't it? A powerful reminder of just how, well, interconnected everything is. We've seen these high stakes legal battles rocking Washington, really challenging fundamental institutions. At the same time, there are these profound shifts happening with tech giants, investment strategies, even our everyday spending. So, our mission today is pretty clear. We've gathered a whole stack of sources, articles, research, our own notes, and we're going to try and pull out the most important nuggets for you. We'll connect the dots, hopefully, share some surprising facts, maybe even keep it somewhat entertaining. The goal is you walk away feeling prepared, understanding the why behind the headlines. Okay, let's dive right in then. Starting in Washington, we're seeing this, well, unprecedented legal challenge unfolding really highlights that tension between presidential power and institutional independence. President Trump's attempt to fire Federal Reserve Governor Lisa Cook, this was August 25th, over these mortgage fraud allegations, it's thrown the Fed into completely uncharted legal waters. This is a first, isn't it?
It absolutely is. No president has tried to just unilaterally remove a Fed governor like this before. And the core legal question, it really boils down to this. Do these alleged mortgage fraud claims actually meet the very high bar for cause removal? That standard exists specifically to insulate the Fed from politics. So trying to remove a governor this way is a direct challenge to that independence, which is, well, foundational for economic stability.
Mm-hmm. And stepping in to defend Governor Cook is Abbe Lowell, 73 years old, veteran defense lawyer. His client list is pretty incredible. Figures from both Republican and Democratic administrations. We're talking New York AG Letitia James, Hunter Biden, Jared Kushner, Ivanka Trump. He was even minority counsel during Clinton's impeachment. He's seen it all.
He really has. And Lowell has this very consistent philosophy about government overreach. It's key to how he operates. He said on MSNBC recently, I have basically challenged the overreach of federal agencies and every administration since Ronald Reagan's. He said, didn't matter whether it's a Democratic or Republican administration. If the government overreaches, then the lawyer's job is to put the government in the right place. So for him, this is about principle, not politics.
And he definitely doesn't shy away from being an attack dog, does he? He called the investigation into Letitia James the most blatant and desperate example of this administration carrying out the president's political retribution campaign.
Pretty strong words. Very strong.
And for Governor Cook, he didn't pull any punches there either. He said, you can't have Director Polk's crazy midnight tweets be the cause for her removal. That's targeting the FHFA director, Bill Polk, directly. Bold stuff.
It is. And this whole situation, it raises that bigger question about protecting the Fed's independence. You had nearly 600 economists.
Right. I saw that letter.
Yeah, including Nobel laureates Stiglitz and Golden, signing an open letter. They're warning that Trump's actions are a direct threat. They point back to the Federal Reserve Act of 1913, specifically designed to insulate the Fed from day-to-day politics. And they argue that weakening the standard for removing a governor, well, it increases monetary policy uncertainty and forces markets to price political risk into interest rates.
Which means higher costs for everyone, basically. That political risk translates into real money. Can you break that down a bit more, like for someone wanting a mortgage or just managing debt?
Absolutely. So when markets see potential political meddling with the Fed, uncertainty creeps in. Lenders get nervous. They factor that uncertainty into interest rates. So yeah, your mortgage might cost more. Car loans get pricier. Businesses might pause investments because borrowing money becomes more expensive. It slows things down, all because of that perceived political instability messing with the Fed. It affects borrowing, growth, everything.
Got it. And it's clear this legal fight ties into Trump's broader push for the Fed to lower borrowing costs, right? He was after Fed Chair Powell before turning to Cook.
Exactly. It's part of that pattern.
And Lowell even brought up Orwell's 1984, talking about doublespeak and weaponizing the Justice Department. That really underscores how serious they see this. Okay, so while that battle rages, presidential power is being tested on another front, too: economic policy. A federal appeals court just ruled that most of President Trump's tariffs are actually illegal. Big news.
Huge news. It was a 7-4 decision, and the court was pretty clear. They said the core congressional power to impose taxes, such as tariffs, is vested exclusively in the legislative branch by the Constitution. Remember, these tariffs hit imports from over 90 countries, China, Canada, Mexico, citing fentanyl flow in some cases with duties up to 50%. They were imposed using the International Emergency Economic Powers Act.
Right.
But the court basically said, nope, that's Congress's job.
And this isn't just a legal footnote. The financial ripples could be massive. What really jumped out at me was that U.S. Treasury yields spiked right after the ruling. Why? What's the connection there for our wallets?
Yeah, the market reacted immediately because suddenly there's this prospect of the government having to refund billions in tariffs already collected.
Yeah.
We're talking $142 billion this fiscal year alone, maybe $172 billion projected for 2025.
Wow.
So if the government has to pay that back, it probably needs to borrow more money. That means issuing more treasury bonds. More supply of bonds pushes yields or interest rates up. Ed Mills at Raymond James, put it bluntly, said it could cause a surge in treasury issuance and yields. And higher treasury yields tend to push up borrowing costs across the economy. Mortgages, loans, again.
So more uncertainty, especially for businesses involved in importing and shipping. They must be scrambling.
Well, yes and no. Logistics experts are actually advising companies to sort of stay the course for now. Don't switch suppliers just yet.
Because an appeal is expected.
Exactly. Everyone expects this to go to the Supreme Court.
Mm.
And even if the ruling stands, figuring out how to refund all that money, it would be an enormous challenge for customs, an administrative nightmare.
Okay, and the judicial checks didn't stop there? Keeping with this theme, a federal judge in California blocked President Trump from using the National Guard or other military troops for law enforcement in the state.
Right. Another significant ruling on executive power. The judge found a willful violation of the Posse Comitatus Act of 1878.
That's the law preventing the military from enforcing domestic laws, right?
Precisely. And the judge issued a stark warning, saying more deployments like the ones in L.A. over immigration protests or those in D.C. could create a national police force with the president as its chief. Really strong language about constitutional limits.
And the political reaction was immediate. Governor Newsom in California was reportedly quite pleased, gloating, some sources said, while the White House called the judge rogue. So clear lines being drawn there, too, between federal and state, executive, and judicial branches. Okay, let's shift gears. Let's talk tech. Because the landscape there is changing incredibly fast, especially with this AI boom. It's reshaping everything. Anthropic, the AI startup, just closed a massive $13 billion funding round, tripled its valuation since March. It's now worth, what, $183 billion?
Astonishing numbers, and it reflects their performance. Their run rate revenue, basically, projecting current performance over a year, has apparently jumped from around $1 billion to over $5 billion this year. That puts them squarely as a major competitor to OpenAI. Investors are clearly betting big on them.
But OpenAI isn't exactly sitting back, are they? They just bought Statsig, a software experimentation company, for $1.1 billion.
That's right. And Statsig's CEO, Vijay Raji, he's joining OpenAI to lead their applications unit. That's a significant move. Shows they want to build more user-facing products, not just the underlying tech.
And this follows their huge purchase of Jony Ive's AI device startup, I.O., for $6.5 billion. That was a push into hardware.
Exactly. As part of this recent buying spree for OpenAI, they're clearly moving towards vertical integration, controlling more pieces of the puzzle, from the core AI models to the software tools, and now even hardware. The competition in AI is just white hot.
So beyond these huge numbers and acquisitions, what's the core shift here? Is it just a few giants dominating, or is something else happening?
That's a really good question. I mean, yes, we see consolidation and these big players trying to control more, like OpenAI getting into hardware. But what's also happening is this rapid diversification of how AI is being used. It's moving beyond just, large language models in the cloud. We're seeing specialized AI for specific tasks, AI embedded in devices. So the takeaway isn't just who's biggest, but how quickly AI is becoming part of everything, physically and digitally. It's embedding itself everywhere.
Interesting. Okay, speaking of big visions, Elon Musk. He claimed Tesla's Optimus humanoid robots could eventually make up maybe 80% of Tesla's value, potentially making it a $25 trillion company. That's a staggering number. 80% from robots. How realistic does that even sound given the competition and the technical hurdles?
Well, ambitious is probably an understatement. Look, the potential is there, maybe long-term, but the competition is fierce, right? You've got Waymo and Baidu pushing hard on robotaxis. And in humanoid robots, you've got Unitree, Boston Dynamics, Figure. These aren't startups, they're serious players.
Right.
Plus, Tesla recently lost Milan Kovac, their VP, overseeing Optimus Robotics. That doesn't help.
Yeah.
So it's a vision, yes, but a $25 trillion valuation based mostly on robots. That's a very, very long shot for the foreseeable future.
Okay, now let's look at a tech giant facing some struggles. Salesforce, their stock is down 25% this year. Worst performer in large cap tech. Ouch.
Yeah, it's a really stark contrast, especially when you look at Oracle. Oracle stock is up 34%.
Why the difference?
Oracle seems to be riding the AI wave much better. They locked in big cloud deals with OpenAI and xAI for infrastructure. Salesforce, meanwhile, their revenue growth has been stuck below 10% for 4 straight quarters. And interestingly, even though they say AI is handling 30–50% of their work, it led to 1,000 job cuts, not the kind of explosive growth investors want to see from AI integration. It seems they're struggling to translate AI efficiency into top-line growth.
Interesting dynamic. And it shows even giants have to adapt. Look at Amazon. They're changing Prime, getting rid of the Prime Invitee program on October 1st.
Right. That program let members share free shipping with people outside their home. Now they're pushing Amazon Family, where everyone has to live at the same address. This comes as reports suggest U.S. Prime signups haven't met targets. So it looks like Amazon is, tightening the reins a bit, encouraging direct memberships, maybe stopping benefit overuse.
Okay, shifting industries, slightly aviation leasing. Big consolidation happening there. Air Lease, founded by the legendary Stephen Udvar-Hazy.
The godfather of aircraft leasing, yeah.
Right. They just agreed to a $7.4 billion take-private deal.
Yeah, led by Sumitomo and SMBC Aviation Capital. This further concentrates power in an industry that already controls about 58% of the world's commercial planes. That's up from 51% back in 2009. And with the current aircraft shortage and record-high rental rates for planes, buying an existing leasing company like Air Lease is seen as the cheapest way to buy market growth. It's a smart strategic move when new planes are so hard to get.
Makes sense. We also saw Lucid Group stock drop after doing a 1-for-10 reverse stock split. Can you quickly explain what that means for a company like Lucid? Does it actually change anything fundamental?
Not fundamentally, no. A reverse split just combines shares. So 10 old shares become one new higher-priced share. The total value of the company doesn't change. It's often done to get the share price up, maybe out of penny stock range, or to meet exchange listing rules. But it doesn't fix underlying business problems, like Lucid's ongoing operating losses. It's mostly cosmetic for the stock itself.
Got it. Okay, let's end the segment on a positive tech note. Google, their shares jumped 8% after winning a key part of that big antitrust case.
Yeah, that was a significant win for them. The judge ruled they don't have to sell off their Chrome browser. That was a major threat the DOJ was pushing for. Now, Google is barred from making exclusive search deals, which could still hurt revenue down the line, but keeping Chrome is huge. And remember, Google still pays Apple billions every year to be the default search on iPhones. That deal helps both of them, highlighting just how intertwined these tech giants really are.
Okay, let's pivot now to investments and your wallet. Specifically, the moves of Warren Buffett, always fascinating to watch, and some policy changes hitting home. Buffett's Berkshire Hathaway has been making some interesting adjustments. What can we learn from them?
Well, Buffett's always worth tracking. One big move. He's sold a lot of Bank of America stock, cut his stake by 41% since mid-2024.
Why now?
2 likely reasons. First, valuation. Buffett is now trading at a pretty hefty 36% premium to its book value. That's way different from the 62% discount he bought it at. Classic value investor moves sell when it gets expensive. Second, potential Fed rate cuts. Lower rates could squeeze bank profits from lending their net interest income. Buffett might be anticipating that.
And he's been selling Apple too, right? Over 2/3 of his stake gone since late 2023. Apple's facing those regulatory headwinds in Europe, the Google antitrust fallout, impacting search fees. Is it just that, or is there more to it? Apple's still Apple.
It is still Apple. Absolutely. A cash machine, incredible brand. But Buffett looks ahead. Those regulatory issues like the Digital Markets Act in Europe and maybe losing those billions from Google, that could pressure future profit margins. And when you combine that with a valuation of, 35 times earnings? For a value guy like Buffett, maybe the risk-reward calculation just doesn't look as good as it used to. He might see better opportunities elsewhere.
Like Domino's Pizza, he's been buying that for 4 quarters straight now, built up a nearly 8% stake. What's the attraction there?
Yeah, it's interesting. The thinking seems to be strong consumer trust. They innovate apparently using AI now in their supply chain and production with this hungry for more strategy. Plus, consistent dividend growth, and they buy back their own stock. It fits the Buffett mold. Predictable business, good brand, shareholder friendly.
And he's also consistently buying Pool Corp, the pool supply company.
Yeah.
Now owns over 9% of it.
Right, that's a different kind of play. Pool Corp offers very predictable cash flow from, essential pool and spa maintenance. People keep fixing their pools. It does really well during long economic expansions. And recessions usually don't kill the maintenance side. Plus, they have a strong record of returning cash to shareholders, dividends, buybacks. It's a steady, long-term compounder type of investment.
Okay, but here's something striking. Buffett expressed disappointment in the Kraft-Heinz split. Remember, he orchestrated that merger back in 2015.
Yeah, that was surprising.
He basically said the merger didn't turn out to be a brilliant idea, and Kraft-Heinz stock dropped 7% after he said it. That's pretty rare. Him admitting a big strategic move didn't pan out as hoped.
Very rare. Berkshire is the biggest shareholder, 27.5% stake. So that comment carries a lot of weight. Shows even the oracle isn't perfect.
Okay, let's shift from investments to policy changes hitting people directly. These historic changes to SNAP benefits food stamps that took effect September 1st.
Yes, the impact is quite significant. New work requirements are kicking in. The estimates are that about 2.4 million fewer Americans, including families with kids, will receive federal food benefits each month because of this. Families could lose anywhere from, say, $72 to $231 a month in support. That's a huge cut for people relying on SNAP to buy groceries. It's a major policy shift.
And it has immediate economic effects. The impact on grocery stores seems really mixed, doesn't it? Independent grocers are reportedly on edge, seeing big drops in business, already 35–45% in some cases. But big players like Walmart, Kroger, Amazon, they might actually benefit. How does that work?
Sure. It's this trading down effect. When low-income shoppers have less money from SNAP, they're forced to stretch every dollar. So they shift their spending towards value-focused stores, the Walmarts, the Krogers, the discount chains, where they perceive they can get more for their money. While the total amount of SNAP spending might go down, the remaining money gets concentrated in these larger retailers, hurting the smaller, local, often independent grocers disproportionately.
And that leads to this other really critical point. The potential trading down of nutritional value. Michael Goldberg at Case Western Reserve put it starkly, the dollar goes farther at Walmart than at the farmer's market. What are the long-term consequences if people are forced into cheaper, less healthy food choices?
That's a really serious concern. If financial pressure pushes people towards cheaper, calorie-dense, but nutrient-poor foods, you could see negative health outcomes down the road. Higher rates of obesity, diabetes, heart disease, all linked to diet. And that creates broader societal costs, higher healthcare spending, lost productivity. It's not just about the grocery bill today, it's about public health tomorrow.
A sobering thought. Okay, let's end this segment on a potential positive, at least for some taxpayers. This golden opportunity in personal finance, using the 0% long-term capital gains tax bracket.
Right, this is part of the tax code changes, often linked to President Trump's tax bill. It's a potentially powerful strategy. For 2025, the numbers are, if your taxable income is $48,350 or less as a single filer, or $96,700 or less if married filing jointly, you pay zero federal tax on long-term capital gains.
Zero tax on profits from selling stocks you've held over a year.
Exactly. So if you're in a lower income year, maybe between jobs, retired, or just managing income carefully, you could sell appreciated assets, like stocks, and lock in those gains tax-free. This opens up strategies like tax gain harvesting, realizing gains strategically, or resetting your cost basis. That means selling an asset and buying it right back to establish a higher cost basis, reducing potential future taxes when you sell it again in a higher income year.
But you need to be careful, right? Consider the whole picture.
Absolutely. This has to fit within your overall financial plan. You need to think about things like legacy goals. Remember the stepped-up basis rule for inherited assets.
Right, where the cost basis resets to market value when someone inherits an asset, potentially wiping out huge capital gains for the heirs.
Exactly. So sometimes holding onto an asset until death is more tax efficient for your heirs than selling it yourself, even at 0% tax. It's complex. Definitely something to discuss with a financial advisor.
Wow. Okay, what a journey today. From those intense legal fights in D.C. testing government foundations to the just incredible speed of change in tech with AI and big deals, and then down to our own finances, Buffett's moves, policy impact. It really feels like everything is constantly shifting.
It really does. And if you connect the dots, you see how these things intertwine. The legal battles affect market confidence, which impacts borrowing costs.
Yeah.
Tech disruption changes investment landscapes and how companies operate. Policy changes directly hit household budgets. Understanding these connections, these currents, it's not just about knowing facts, is it? It's about seeing the patterns, maybe anticipating what comes next.
So what does it all mean for you listening right now? It means getting a handle on these interconnected changes isn't just, being informed like trivia. It's about being prepared, ready to adapt, whether that's making investment choices, adjusting your budget, or just making sense of the news swirling around us. So here's something to maybe think about this week. How might this ongoing tension we've discussed between tech disruption, government action or reaction, and our own individual economic resilience, how might that fundamentally reshape what stability and opportunity even mean in the years ahead? What will security or growth look like in that constantly shifting world? Lots to ponder. We'll see you next time on The Deep Dive.